ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar. It's Friday, last day of the week, and one of our last webinars. There is one more webinar coming up next week on Wednesday. Then on, we will be talking about the advantages that we can grasp from range trading systems, which will be slightly different than today's topic. However, today's topic, ladies and gentlemen, we will talk about the dual grid trading system, which of course involves the horizontal grid, or also called the price axis grid, and of course the one that we've already talked about for the past webinars, the vertical grid concept. Of course, ladies and gentlemen, this time we are definitely not going to use the Fibonacci fan as a measurement of trend. However, of course, this tool particularly can be used as separate, just as a further confirmation whether the market is trending or ranging. The concept of the dual grid strategy, ladies and gentlemen, is mainly because of the choppy and volatile market, and this particular system can be highly effective in these market conditions. Before that, however, first of all, let's remind for a few minutes here what we've talked about for the past webinars. It's very important, as mostly our today's focus will be on both grids, vertical and horizontal, as well as timing of the market and, of course, price during this particular time intervals. The time intervals, as we spoke last time, in the vertical grid does not necessarily have to be constant, like each and every time frame to be between 1 hour or 4 hours and so on and so forth. It could be 15 minutes, 30, 45, plus a 1 hour to 4 hours on a daily basis as well, so on and so forth. So depending on the time intervals that you are placing, on the number of the time intervals, every time interval will be either smaller, like up to 5 hours, or it could even extend to 32 hours or even more than a week. So let's suggest that we will not have more than 5 intervals in this particular system. Basically, it's much easier to calculate and much easier to grasp within the interesting points of the system itself, and of course better to incorporate into any trading plan by easier to understand what it actually does and how we can take advantage of any market conditions. So far we've been talking about vertical grids for trending markets. Today's focus, however, on the dual grid system. This is a variation, ladies and gentlemen, on the grid trading theme, which we've talked about so far. The basic difference between this system and the classic vertical grid system is that we place buy and sell grid legs at the same price levels. So this means we're both long and short at the same point of time, meaning we are actually hedging ourselves, one from any position, but once the system is completed down to the final trade which has to be executed, the average dollar cost aversion, and when you take out the spread with the commissions that you're paying, as well as profit minus the loss, in a sideways direction, this system 95% of the time is generating hefty profits. Of course, when we talk about hefty profits on a sideways direction, we have to assume that we will be talking about smaller time frames, like 15 minutes to 30 minutes charts. Therefore, the pip size in our profits and stop losses would be rather smaller than what we've been talking about on the 1-hour chart so far. Especially when we talk about trending markets, we need to look a little bit of a larger time frame so we can catch a better trend, much better opportunities for profit on the market. But this particular system does not really care of which way the market goes. As it's in a range, it usually goes both ways. But we do understand that at some point of time, the particular range that we're trading will be somehow broken, and of course, a new directional trend will establish, like an uptrend or downtrend. Furthermore to that, this means that a bit counterintuitive but choppy or a volatile market can give us a very high effectiveness on this particular system. One thing traders like about this particular system, as well as I've been presenting it so far to several of my traders in a one-on-one session, they pretty much like it a lot. It's quite nice, especially when we talk about uncertainty of direction. That means that we don't need to forecast the way in which the market is going to go. This is one of the key advantages until that point. However, one important difference between this and a normal vertical grid is that this method can lose if there's a strong rally in one direction, up or down. So we have to be prepared. So when we are using this strategy, we need to carefully manage our stop losses and take profit levels. This is the ultimate key into profiting well from this particular system. It's been tested for a very, very long time, I have to assure you that. I've been trading for quite some time on this system. It works extremely well with ranging markets, as well as we're at least on 5 major instruments right now on a ranging market, especially on smaller time frames. Some of them are even up to 4 hours in a sideways direction. When we talk of 4-hour direction, 4-hour charts and a large number of pips, I could add as an example the gold as a precious metal. This particular commodity is in a $36 range, so you can imagine the possibilities in this case. So let's have a look at a few examples so we can see how this particularly works. We can also, of course, create ourselves the so-called Excel spreadsheet to do the calculations for us. However, we're not going to go so deep into calculations today, only to avoid the particular confusing opportunities here that I might cause, which I'm actually trying to avoid, based on the fact that we need to grasp the whole concept rather than to go too deep into calculations so we can verify whether it's working or not. This is something that you can deal on your own. I will just give you the formalities. I'll give you the rules on the trading system, the proper risk management approach that you have to grasp along the way, and of course to see that this will allow any particular trader to tune this system so finely that basically it will bring you down to a minimum risk on your particular accounts. And let's say we're looking at the Euro-USD chart. I have picked the 30-minute chart, but let's have a look on how the 15-minute chart looks like. It's very important so we can find somehow very good opportunities in the particular range when we look at it on, let's say, on a 30-minute chart. Let's consider this particular range, which is somewhere like from here on to here. This would be our range for quite some time. You can see it's a pretty large range, but when we go down to the 15-minute chart, we can see that this range will give us a very good opportunity to execute our system. Now, let's say we're in this condition, perfect condition here. The price is very close to the upper range in this moment. We're always, of course, monitoring whether the price is going to break through any of the ranges. There are false breakouts, ladies and gentlemen. Don't get me wrong. It's what you saw at the end of the range itself before it actually got broken out. Now, a range breakout has to happen in a large volume. Basically, when you're looking at a small time frame like 15-minute chart, it has to have more than 60 to 70 pips candlestick in direction of volume, so you can actually consider that the range is actually broken. But if you see small candlesticks breaking out of this range, it's very likely that this is the so-called fake breakout, and the price will get back into the range immediately after it closes a few sessions outside of this particular range. But what we need to remind ourselves is what we're here for. We're here for timing of that market. So we have about 5 considerable type of trades. All right. I'm not going to time them into a very specific so-called time frame. Like I can consider a 1-hour time frame for each time interval, or I can consider 30 minutes. This would be 2 candles. But let's consider a little bit larger time frame, like in 4 hours, so it can give us a bit of a better overview on our timings. Let's consider this as our first entry here. Our second would come, let's say, somewhere here. The next one would come in an equal interval somewhere here. Another one will come somewhere here. Also, we've got one that comes somewhere around here, for example, and let's put another one that comes somewhere around here. You can see that it's a very tight market in this case. What we need to understand is that when we shrink it in, it's not going to give us a very good idea of what the market is doing, rather than we can see the direction, basically. But when we stretch it by far, we can see, let me just change the color of this, or no, I'm just going to leave it as a red color, but when I start putting on the price axis horizontal lines, we'll just change the color so we don't get too confused. So now we know what is the time interval that we're going to enter. We know where our first entry is. Let's say we've anticipated a bounce off from the upper range, so we've waited for a large volume bearish candle like this one, and we have our first entry over here somewhere at this point of time. And let's change our colors. I'm just going to go for the greenish line. It's better distinguishable. Now, when we talk about dual grid trading, when we profit from the one side of the market, let's say upside or downside, the other one is actually on the losing side, or vice versa, which means we're basically hedging one position with another. There are several ways to trade with this particular system. One, of course, involves managing the 2 grids as 2 entirely separate systems of trades. Each side has its own take profit and stop loss. The second option is when we use swing strategy that involves managing the trade pairs individually. This can work, of course, if a volatile or a whipsaw price action is expected, like this one, for example, here. Okay, this will involve a different particular setup. In a quiet market, you can use the timing as your entries and exits. But when it's in a volatile market and we're expecting large announcements, which we don't want to miss, because in these conditions, when we're using the dual grid trading, we're profiting from pretty much both sides of the market eventually. So at the end, on the drawdown, when we consider all 5 positions, 3 of them, for example, will be profitable, and 1 will be, 2 will be on the losing side. However, different stop losses and take profits in a quiet market from the first option are not considerable. Basically, when we're talking about swing system TP and stop loss, in this case, profit targets are set on each trade individually. In this case, for example, we have I've particularly used, let's say, we're looking at a 15-minute chart, considerably small period of time. So we need to consider rather smaller pips in size of profits and smaller pips in size for our stop loss, with of course considering the spread, which for this pair is somehow close to 1 pip usually, most of the time. So let's say we're going to use about 20 pips of take profit in about 30 pips of stop loss, plus the 1 pip. That could be 31 pips in stop loss when we consider that spread. But in most of the cases, it wouldn't make much of a difference rather than the fact that this particular pair is with one of the tightest spreads on any market. But there are currency pairs, like most of the exotics, that have larger spread, which you need to consider that as well. Some of them might reach even to 10 pips, you have no idea. Especially when you're looking at smaller time frames, this could cause a very huge difference to your eventual drawdown on the end of the month when you're looking at your profits and trying to consider whether this particular strategy is worth it or not. So considering the fact that this is our first entry here on the price axis, we can see that it's 1374 as a price. First of all, guys, let me ask you and remind you that if there is something that you don't see from the chart, like the time intervals down below or the price axis on the right side here, please let me know in a message into the chat here in our system, and I might be able to shrink a little bit the chart or minimize it a bit, so you can better see all the borders of this particular MetaTrader 4 platform, so we can experience the whole system as it should be. So, right here, in this moment of time, we have 2 positions. One is long position and one is short position. Now, considering the fact that you're normally entering in relatively one and the same price, considering the spread that it's 1 pip, it usually makes no difference in this case. So when we lose from this position, we profit pretty much the same size. Considering the fact that we have chosen to use about 20 pips of take profit and about 30 pips of stop loss, for example. You can see how far this goes. So in each direction we have both. So eventually, when the stop loss is not hit, the take profit on one of this trade, which is the profitable one, can actually make up for the losing trade and make the difference between the losing and the profitable trade. So let's say if you have brought those 2 positions in eventually, of course, because here in this time interval, you will enter with another different position here, which is on a different price. But considering the fact that our possibilities on the market are very limited, especially on the sideways direction, we have to very carefully consider what would be our particular take profit and stop loss, which in this case is not actually considered to be 2-to-1 risk-reward ratio, because in this case your take profit is 1 time smaller than your particular stop loss. And in most of the cases, the drawdown at the end of the month will not bring you on the profitable side of the system. Rather than that, half of the take profit is added to the stop loss in order to achieve what we're looking for. Especially in a tighter range, as we can see that in this particular moment of time when we have chosen from 1, 2, 3, 4, 5, and this is the sixth one, position, for example, we have a particular range, so when we measure it, it's going to be a very, very tight one. It's about 20 pips in size. So therefore, we can consider that our take profit should be about 10 pips. Our stop loss should be at about 15, but not more than 20 pips. Which means on every 10 pip to the upside and every 10 pips to the downside, we have to consider our new entries like this. For example, we have the possible positions in timing. Here, this is, let's say, 10 pips. This is another 10 pips, but this is already out of the range. However, it's still considered as a possibility. Basically because the price action on a large volume could even bring the price up there, take your profits, and get back down within that range in a short moment of time. And this is what we've seen on the market. To eliminate this risk, we are ready to place the same orders on the other side of the axis to the downside to normalize our drawdown at the end of the month. And each time, now this is something that I have to erase, but this one should have been over here. This is where we've seen the crossover in price, okay? So we have our timing and our price. These are our take profits, and our stop losses would be considered with a red line, for example. It should come somewhere here and here, here, and furthermore up there, here, here, and down here, for example. This is just an example here. I'm not putting too much lines for a very basic reason. The stop losses are that you have to calculate are about 5 to 10 pips larger than the top take profit for any of the positions which are taking long or short position. But right now we're mostly focusing on the profits rather than the stop loss, which also has to be considered. But I'm not going to put them on so we don't get too much confused with different lines. So we have our price for a take profit. We have our timing. Therefore, we are entering over here as in the time interval on the vertical grid, and we're taking our profit over here when the price is reached, because this is our pending order, our pending stop loss, for example, or take profit. I'm sorry. Therefore, as you can see, in a few sessions time, we have our take profit hit. We have another position here that is running. This one is going to be short. The long position is already achieved. Our stop loss is not yet hit. So basically, when the price starts declining, we have already achieved our profits rather than our stop losses. But if it's vice versa, we had a, let's say, long position here. We've profited once here, but then suddenly the price reversed and hits our stop loss, for example, it wouldn't be that much of a problem. Basically because as long as the range continues between the these two lines here, between the upper range and the lower range, you can keep placing those trades until it's still valid on one and the same time frame, or rather for a longer period of time you can switch between the time frames. However, you have to consider larger in size take profits and stop losses to avoid sudden position cutoff, for example, which in most cases could be devastating to your accounts. So the essence, ladies and gentlemen, is to buy and sell on one and the same time. Doing that, at the end of the drawdown, we can assure ourselves that the profit would be much larger than the loss sustained during the whole period of these trades. The important concept here to remember is that when considering these time periods, they have to be considered from the prior trend. So basically we have to find our reference points. Let's say the reference point is 1 hour. Each hour, for example, this particular currency pair is making a move. It doesn't matter in which direction. That means any interval has to be about 1 hour or even less or more. This is something you have to consider, not only for this currency pair, but for all that you are looking at. So the risk control with the dual grid system is a risk management type of system that has to be always involved in this particular concept. As well as trade management is easier when the two grids are treated as separate systems, for example. What I mean is when you're always long, your long positions are one grid. Your short positions are separate grid, is a second grid. When you're managing those two grids separately, okay, the long positions separately from the short positions based on the past performance of the sideways direction range, meaning every long position has to have a separate in size take profit and stop loss, and every short position have to have a different stop loss and take profit based on past performance of this range direction. Which means if we do that, this basically have the perfect defined boundaries of our rules for this system. This will help us decide if one side of the grid should be closed prior to the other one. And this is something that can primarily tell us whether we should switch to a vertical grid system separately and trade only the trend, or we have to keep trading this particular dual grid system for the time period until one of those grids starts failing. What I mean is when we trade the trend, we're rather entering on the time intervals rather than the price intervals. But when we're trading the sideways direction, we're using both price and time intervals. There is a second way which you can use the dual grid system, is by avoiding the time intervals in a sideways direction. You can only use the dual grid by trading only on the price axis, which means you can use the price intervals rather than the time intervals. So you see, ladies and gentlemen, the flexibility of the whole picture, the whole system, gives you opportunities depending on the market conditions, depending on volatility, depending on fundamentals on the market on the current stage, whether we are well into the US market and the US market is the only one that is controlling the world markets at this stage, or we have the European, the US market, and partially from any other market that is currently active and trading that is influencing the exchange prices between currency pairs or commodities. All of these factors will give us even more information on what exactly we should be using at this particular moment. So that's why the system is performing very well on small time intervals like 15-minute charts, 30-minute charts, rather than the vertical grid system, which performs much better on larger time frames like 1 hour and 4-hour charts. So before we call it a day, let's take a look at a few examples of what could be, which could be the advantages and of course the disadvantages of this particular system, because it's very important to know why we're actually using it. Well, the first thing is the advantage of this system. Now, what we don't need as an advantage is to be able to forecast in which direction the market will move. Basically, what I mean, we don't have to forecast it. is in the short period of time. Whether in a particular larger range, you know, as into this 100 pip direction, we don't really need to know whether the market is going to go up or down within this range. The only thing we need to know is that we're going to use the dual grid system. It works well in volatile markets and on sideways markets. It can be very high efficiency. It can have a very high efficiency under right conditions, especially rapid price swings across that particular grid, as we can see right here, right here, right here, right here, for example. Those rapid price moves can give us a very good profit potential, as well as we will know where to cut one of the side of the market, one of the grids, and let the other one achieve the profits. So as an example here, I can add to this particular downside movement, which was about close to 60 pips, considering the time frame. Now, on one lot, this is about close to $600 in profit when you take away the entries like spreads and so on. When we see those rapid bearish movements, we know that long positions here will not achieve anything. So in the price interval, we will enter only short positions. Basically, we're abandoning the long position grid and only leaving one grid. This is the short grid, so-called. This is how we can profit only from one of the moves, only in one of the direction. And of course, it is relatively simple to automate this particular system, as into expert advisor, if you wish, or a type of strategy that will calculate the overall grid profit and loss. So basically, you don't have to calculate everything by yourself. You can use Excel on a spreadsheet to calculate for you what should be your particular take profit and stop loss. How you can do that, of course, I can help you on a separate session, on a one-on-one training. We can sit down together. I can show you how you can use the Excel to do that. Basically, this is not something that we do for webinars, you know, type of Excel calculation. It's not the particular concept of our webinars, but I am willing to do that, to go within these depths for you, so I can make your trading even easier, and to show you how you can do that, to simplify your trading and conserve your time, to automatically calculate your overall grid P&L. The disadvantages, however, are not to be missed here. We have to talk about it as well. Now, this particular complex system requires more trade management than using in either the single vertical grid or only the horizontal grid. Because of the particular hedging system, the dual grid doesn't work well when there are strong directional trends and fewer price swings, because of the fact that on the price swing that it's returning to your initial opening, you can cut the particular losing trade earlier than your take profit would be achieved. And the differences between these two prices, you know, these two profit and loss, would make your day. Because when we're talking about smaller time frames, smaller pip size, we're talking about larger lot sizes. Therefore, at the end of the day, you would make pretty much the same amount of money that you would make on a normal trading. However, the risk is by far less than any other system. And this is what we're actually trying to avoid too. Another thing, it can result in heavy losses if the take profit or stop losses are not properly managed. So as I mentioned earlier, it's relatively very simple to calculate the overall P&L on this grid by using Excel, or you can do that on your own by your hand, calculating what's the average range distance for the past, let's say, 20 sessions or 40 sessions. When I'm talking about 20 or 40 sessions, that would be the time frame. That means the last 20 15-minute candlesticks or the last 40 15-minute candlesticks, depending on the type of risk that you're willing to take. So all of this comes as a disadvantage. However, the advantages are by far more than the disadvantages, and the flexibility of the system gives you the opportunity to choose a single grid trading or a dual grid trading. Therefore, you have a system with a minimum risk on the market down to 5%. But everything has to be calculated very, very carefully, because a single mistake can actually cause the whole system to collapse. So you're either going to guess once in a day, for example, and you're going to make a large profit, and the other time you don't guess right, for example, on your calculations, then this particular loss could wipe out your profits or even deliver higher losses into your daily trading. And the other particular disadvantage is that it's mostly suitable for smaller time frames because of the price swings, which are much more often seen on smaller time frames rather than larger time frames, because when we're talking about larger time frames, we are mostly going to focus on directional markets, strong trends, which then we will consider a single grid trading. So this is the whole concept, ladies and gentlemen. Don't forget to send us your questions as you usually do. So this is pretty much everything for today and for this week. I will also remind you that the possibilities are numerous with us, with the company. It's very easy to get in touch with us. Just get on our website, GDMFX.com. Find the support department. Actually, a chat from the lower right corner will pop up on your screen. You can ask any question you like, or even request a one-on-one session with me personally or any of our other account executives, which can help you in any case. And of course, for new traders to our firm, which are attending the webinars, we have special prizes, bonus systems, or a specialized type of trading account, which can even better assist you into your profits. Please remember that this particular webinar is also recorded, and it will be uploaded as soon as next week, so you can review everything else that you've missed. Or if you have any other questions, you already know. Just go to gdmfx.com and find us there. That's all for today. Thank you for joining us. And of course, don't forget the last webinar for this month is next Wednesday, Advantages of Advanced Range Trading System, which is another type of range trading system which can help you also to implement it within the dual grid in order to maximize your profits even better. But this you can also accompany within your particular trading plan. It depends. That's why we're making so many varieties of different strategies which can be suitable for each and every different individual. That's all from me for today. See you next time. Bye-bye.